What's up, investors? You're watching the Bitcoin Plethora podcast. Today, I'm joined by a very special guest, Mr. Greg Foss. Greg, thank you for doing this.
It's my pleasure. Thanks for inviting me.
Yeah, Greg. Greg has a paper called "Why Every Fixed Income Trader Needs to Consider Bitcoin as Portfolio Insurance." This is a great paper. There's a link in the description. Highly suggest anybody read that. It's digestible, especially if you're not familiar with the bond market. That was a big reason and why I'm so honored to talk to Greg. He's putting some complicated subjects in digestible terms, and that's something that I believe that we need. So you went to Cornell University, right, in the United States. Greg's from Canada, if anybody doesn't know. Mm-hmm. He went to Cornell University, and from there, like from your professional experience, can you start and elaborate a little bit about that?
Yeah. So, I mentioned to you on the silent part, or just the beginning. So I was an engineer at heart. I shouldn't say that. I'm an engineer trained in undergrad. So I love mathematics. I believe math is the base layer of language. In other words, if you're English speaking and you're conversing with a Spaniard, mathematics is your base layer of your language. Okay. Then you have your second layers, which is your mother tongue. So math, I'm comfortable with math, and I knew that, I didn't want to be an engineer per se, but I did like the mathematics side of it. So I parlayed that into a opportunity to go to school in the US, which was pretty important because, first of all, there's huge differences between the cultures of Canada and the US, and you don't realize that until you live with a bunch of different guys. And I was lucky; I had a great group of roommates down there. And that was 19. I graduated McGill 1986. 2 years later, I graduated Cornell 1988. And I did come back to Canada. I'm not telling you I had a ton of job opportunities in the US, but I certainly could have stayed there. But I wanted to come back to Canada and try and make a difference. And I landed a job at the Royal Bank of Canada, which was Canada's largest financial institution. Still is, but at the time was Canada's largest financial institution. And I was working directly for the chief financial officer, the CFO, on special projects. That would include mergers and acquisitions candidates, pricing of their loan book, all sorts of stuff. And one of the most interesting projects I worked on very early on in my career at the Royal Bank was the Brady bonds, which was a solution to the LDC debt crisis that was enveloping all money center banks around the world. Money center banks had made loans to lesser developed countries, primarily in South America, that were US dollar based. And because of currency fluctuations and declining credit quality, the countries of Brazil, Mexico, Argentina, in South America, but also Philippines, Vietnam, had all failed to pay back this debt. And this debt was a huge, basically uncertainty on the balance sheets of all major banks in all major countries. Okay. So Treasury Secretary Nicholas Brady had to propose a restructuring plan for these particular loans. And it was my job. It's quite an exciting job. It doesn't sound like that big of a number today. We had close to $1 billion of Mexican debt, and I had to price that debt and determine what Brady plan option I was going to advise the CFO to take. And pretty cool, except that along the way, I said, well, let's just look at the whole portfolio to begin with. And the whole portfolio was such that if you had marked down all the loans to market to the price they were trading at in the secondary markets. Now, there wasn't huge volumes that were trading, but there were trades that were taking place generally in the 20 cent on the dollar range. If you had taken our total book and marked it down to market, we had about $4 billion in total. We would have to write off about, $3 billion of debt. And I flip to our balance sheet and I look at our book value of equity and I'm like, holy crap, we don't have $3 billion of book value of equity to write down. Right. We are insolvent. And I'm like, how is this possible? This is just unbelievable. And, obviously the bank analysts had no clue. Treasury Secretary Nicholas Brady certainly did. Anyway, he basically effectively turned a 5-year obligation into a 30-year bond, thereby, and he secured that bond with his U.S. Treasury zero coupon debt that would over 30 years accrete from about 13 cents on the dollar at the time up to parity. So just by the fact that the loans were secured by U.S. Treasury zero coupon debt, they did not have to write them down to market. It was accounting gimmickry, okay? But I just looked at this and said, you don't learn about this stuff in school, and this is pretty scary. And since 1988, okay, I had been looking for a solution to what I termed a fiat conundrum, because banks are thought of as being too big to fail. And that is true. But what is their backstop of last resort is the governments. And the governments can backstop them. How? Why? By being able to print money, very simply. So I said, who in their right mind would put their deposits, their hard-earned deposits, in a bank that can fail regularly if it wasn't backstopped by the government? So, I know this, I don't want to get there too quickly, but certainly this was 30 years ago. I was looking for solutions to what I term the fiat Ponzi. And 30 years goes by and I traded credit the whole time. I've been through some pretty intense credit meltdowns. We can talk about that if you want. But yeah, so I started in 1988, and it was pretty eye-opening. And I'm going to quote Henry Ford here. Henry Ford said in around the 1920s, he said, if the average American understood how the banking system worked, there'd be a revolution overnight. Okay. Yeah. And that's true. I mean, that's basically the way it goes. And, the average American still does not understand how it works. And I'm actually convinced that even some of the senators, including Senator W, that, is a Massachusetts senator, has no clue how the banking system actually works. Okay. It's really sad. It's really scary, but it is a fact of life.
Right. And that was a big reason too, that I wanted to make this type of content and try to, get people talking about it. I wanted to unpack something that you said a little bit earlier when you were talking about working at the Royal Bank of Canada. You had mentioned that it was insolvent. Can you describe a little bit or elaborate a little bit how these banks can operate and function when they're insolvent, and what caused them to be insolvent?
Sure. Okay. So let's define insolvency. So basically, the insolvency is defined when your liabilities exceed your assets, and essentially, therefore, your book value of equity is vaporized. Okay. In a bank, your liabilities are your depositors' money, and it's weird, but a bank, the loans that you've made are actually your assets. Okay. Mm-hmm. So you have to net those two out. And typically a bank back in 1988 only had about 4 cents on the dollar of equity capital for every $1 of loans they made. So what does that mean? It means you have 4 cents of equity capital, which is your risk absorbing capital for when there's defaults on those loans. The other 96 cents on the dollar is either retail deposit money or interbank deposits or a portion of subordinate debt. Okay. But again, there's only 4 cents on the dollar that's risk absorbing capital, which means if you have a loan that you've made at 100 cents on the dollar and it goes down below 96 cents on the dollar, that particular loan is now cutting into your book value of equity because there's risk of impairment. So that's what banking is. The leverage ratio at the time was 25 times, right? Because you have $1 and you only have 4 cents of capital, which means you're levering that 25 times. Mm-hmm. The banks have become a little less leveraged, but in my opinion, it's still a goofy number because that only includes on balance sheet exposure. It doesn't include all this off balance sheet exposure, which is derivatives and all the other beautiful things that the capital markets come up with. But so that's what banking is. And again, you need to understand it's insolvent on a regular basis. I'm convinced the banking system was I know with certainty the banking system was insolvent in 1988. Mm-hmm. I'm convinced again that it was on the brink of insolvency in 1998, which was the long-term capital crisis. Okay. Mm-hmm. There's no question that it was insolvent in the great financial crisis, which was 2008 and 2009. And I'm going to contend that it was insolvent last year with COVID until the Fed stepped in and said stuff like, we're going to buy high yield bonds to stabilize the market, to stabilize the credit market. So this is what happens. It's like a bus going by. It happens regularly. It happens when you have that much leverage in the system. And it is dangerous if you don't understand the risks that you were exposed to.
Yes. Also, in your paper, like when you were just discussing that you could contend that last year in 2020, that there was a period that they could have been insolvent. In your paper, you discuss kind of like a new form of quantitative easing, where the Fed is buying corporate credit.
Yeah, so that's a great question. Thanks for reading the paper, by the way. There's a lot in there. So the Fed did buy, for the first time in its history, corporate credit in the last financial crisis, the COVID crisis. Because why? Well, essentially, it's my belief that they said they could buy, and they actually did buy high yield credit, due to 4 different credits that are all large American companies, that if they had been downgraded from low investment grade, so this is a credit rating supplied by the rating agencies. It's a subjective rating, but they were all rated in the low end of this subjective terminology called investment grade. If they had been downgraded 1 credit notch, they would have been downgraded into the junk spectrum, or high yield, which would have forced selling from managers that cannot own high yield bonds or any bonds that have been downgraded. Well, those 4 companies, let's go through them. They were Ford, General Motors, AT&T, and General Electric. Okay, the combined balance sheets of those 4 companies are bigger than the high yield market. Wow. And all of them were on the cusp of being downgraded. The Fed had to step in. Why? Again, what happens in the public credit markets is reflected in the private loan markets as well. Spreads widen in correlation across the different asset classes. A spread being your measure of risk to compensate lenders against default, against the typical risks in banking, which include operating risk, liquidity risk, and default risk. But that's a credit spread. But if it widens in the public markets, you can assume that it's happening in the loan markets as well. So all of these companies had bank debt as well. So if the high yield market is blowing up, then the bank debt market is blowing up. And consequently, so is the equity of the banks. And you saw this. And so the Fed needed to stabilize the system, and they smartly put a backstop on high yield bonds. But my God, again, it's just what next? Like I lived through it in 2008, 2009, and that was a subprime mortgage crisis. Mm-hmm. Now this one in 2020 was the COVID crisis, which, that was a macro event that came out of the blue. I certainly, in my life, and I'm 57 years old, I lived through some SARS scares, but I'd never seen anything like COVID. And man, oh man, did the media ever play it up for something that could be, it's like from outer space. So the world shut down. The Fed did what they had to. I felt in 2008, 2009, the Fed also did what they had to, because the world almost did end in 2008, 2009, so the financial world. The Fed, though, what they didn't do in between these 2 macro events was pay down the debt that they accumulated in 2008, 2009. They just kept kicking the can down the road. No discipline, expanding the balance sheet, expanding the tools that can stabilize the world. And here we are. We're in a, we're in a world where it is impossible that fiat currencies do not debase because of the amount of debt that has accumulated on the balance sheets of, on the balance sheet of the world, essentially, because you have government debt, then you have corporate debt, which is excessive. You have personal debt, which is excessive. You have bank debt. All of this debt combined gives you a metric where it's impossible that your fiat currency does not debase. It's only math. I'll come back to my start. I love mathematics because it is the base layer of language. It's also the base layer of calculations. People who don't study math tend to make outrageous comments like, okay, well, we'll just print our way to prosperity. These are the academics who, liberal arts gurus who say shit that will cost my children a lot of money. And that's what, what concerns me.
Right. Yeah, that's kind of goes back, I guess, to what kind of economics you're looking for, right? Like we're kind of Keynesian economics and Austrian economics. Planning, lowering your time preference, planning for the future. Obviously, that's Bitcoin. Fits in there, but I wanted to talk a little bit about the credit markets.
Sure.
You described the credit market as the most unforgiving. You've also said the credit guys are kind of pessimistic. They have the approach to ask how much they could lose when equity traders more or less are optimistic. How much can I make?
Yeah, I think I said trees grow to the moon, right? If you're an equity trader, trees grow. And that's true. Some equities can go to the moon. Debt is asymmetric to the downside. If you lend $100 to a company over a 10-year term, and you put a coupon on that, just to make the math easy, let's say it's right now, the same coupon is high yield right now is about 4%. So you say, okay, I got $100, I'm lending it to you at 4%. And in 10 years, you're going to pay me back $100. And each year I will collect 4% interest from you. Let's say that company is doing really well and their cash flows exceed expectations. The debt or the coupon, the company will never come to the bondholders and say, we're doing so darn well, we're going to increase that coupon to you, right? We're just going to, that value accretion flows down to the equity.
Right.
Conversely, if companies don't meet expectations and your 4% coupon is no longer sufficient to reward you for the risk that you're taking to lend to that company, the price of the bond will go from 100 cents on the dollar. It'll start deteriorating to reflect a higher yield to maturity. Right. Okay, so your $100 might start trading at $90, and all of a sudden you've lost 10% of your capital on a mark-to-market basis. But the yield, let's do a quick math. So let's say it was a 10-year bond, so it's an 8-year duration. You've lost 10 points, so that's about 100 basis points. Your yield to maturity would have gone from 4% to 5% if you bought it down at 90 cents. But in theory, that bond can go all the way to zero, right? Because let's just say that company defaults and there's no assets left for the bondholder even after you've restructured it. That's why bondholders are pessimists. You lend money at $100 or $100. It's valued at a dollar on the dollar. It may go up to, let's say, $105. But if you sell it at 105, all you've done is given away a coupon that was overcompensating for the true risk at that time. But then the flip side is, man, it can go down 100 points from when you first lent the money. And, the only consolation you have is that you are a prior claim on the assets of the company than the equity holder. And that means that unless the bonds are worth 100 cents on the dollar or the debt is worth 100 cents on the dollar, the equity is worth zero. And this is what all equity guys need to understand, because most of them don't. With any equity analysis that you do, you better start with what the credit rating of the company is and what their debt is trading at, rather than just blindly go into the equity market and purchase their equity, because it's a Reddit name or something like that. Okay.
Right.
It's dumbass stuff. You play stupid games, you'll win stupid prizes over time. Right now, the government's given the Reddit people so much money that they can actually make stuff come true. But did you know that the AMC bonds, for example, that were outstanding, traded down to under 5 cents on the dollar? But these idiot Reddit fucking, excuse my language, if you can let edit this out. These idiot Reddit investors. Oh my God, it's a short squeeze. Come on, why do you think there was short equity? Because the bondholders were shorting the equity against their bond position again. Because if the bonds aren't worth 100 cents on the dollar, the equity's worth zero.
Right.
So okay, let's say I bought the bonds at 5 cents on the dollar. Yeah, I'll sell some equity to these stupid equity people because I have 20 times upside on my bonds versus the equity that's, again, worth zero. So these are the games that happen in not games. This is called capital structure arbitrage. It's something I did for 30 years. Look, I'm not against trying to squeeze shorts. I'm just against people that think that you might as well try and squeeze a short without understanding, hey, what you might do is go in and buy some of the bonds instead of the dumbass stock that you're looking at. But Reddit people typically didn't take a lot of mathematics or finance either. So, and by and large, I hope I'm not insulting your listener group too much, because again, you got to start your analysis of a company with where the debt trades, given that the debt has a prior claim.
Well, that's the reason we got you on, is because we want to learn. We get to learn, and that's really what it is experience. And this day and age, right? And especially with the access, right? Robinhood, Webull, all this, people.
And most importantly, a check that the government gave you for some of the casino chips that you can play with, right? Let's not forget that you could be a professional investor in practice only until you actually get skin in the game, meaning money. That's when it turns real. And if the government just loaded up your bank account with some of these poker chips, and poker is a good game if you play it well, risk analysis. Look, that's all it is. It's a game of probabilities. There's no difference between investing and poker. It's exactly the same mathematical probabilities. You need to do your math.
Right. I heard you say it in a couple other podcast appearances or maybe in a tweet, but you had a quote, something like, the bond and credit market is the dog and the equities is the tail.
I owe you some, these are good, man. This is so exactly. So look, if you don't, you got to understand that all markets, firstly, the credit markets are way bigger than the equity markets. And given that equities are a subordinate claim, if credit is the dog, the equity is the tail that gets whipped around. Again, by, let's say, a bond guy says, God darn it, I'm going to get crushed on my bonds. There's a good chance that you're not going to get 100 cents on the dollar back. So why don't you go out there and short some equity against your bond position to hedge? Because if there's the upside that it comes back to 100 cents on the dollar, then you could buy more at 60 cents on the dollar and you make that trade. But listen, it's just so many people don't understand where the bonds are trading, including some influential editors of some magazines that get a lot of airtime. And I'm not going to call out any names, but I'll just say, like, there's a lot of names that the capital structure arbitrage made no sense, but it was just that these new investors had money to play with, and some of their investing habits could certainly be questioned from an old timer like me. But ultimately, they could have made money. I just argue that they would have made a better risk-adjusted return by actually owning the bonds rather than the equity itself.
Right. And, I wanted to also get into a little bit. You touched on it. We've touched on it, briefly throughout so far. You brought up 1988. You brought up 2008. the great financial crisis. Were there similarities in the lead ups between the two? What was different?
So great question. Great question. 1988, I was too young to appreciate and the markets were immature back in 1988. The biggest one that started this whole thing about volatility and correlation between markets was actually 1998. That was the long-term capital management, LTCM crisis, where you had two Nobel Prize winners that worked at a hedge fund on Wall Street called long-term capital management. They levered themselves 90 to 1, and they were called the Bank of Volatility. And their pocket trade was to sell volatility. Now, over time, volatility generally compresses, but what happens in vol when there's a crisis is that vol explodes to the upside. There's an expression, volatility takes the staircase down, but takes the elevator up. Okay. And what happened in 1998 is there was a crisis. I don't remember what it was, the Thai bot maybe, or something like that. Who even knows? But volatility was exploding. And Wall Street was running to the Bank of Volatility for protection. When you want protection, you purchase vol. Volatility is when you are long volatility in a crisis, that's when volatility goes from, currently it's around 15%. It goes to 85 or 90%. Okay. Well, that's just like a stock that goes from $15 to $95, right? But when this hedge fund was selling and selling and selling and selling and selling, clearly they were insolvent. And these Nobel Prize winners go some dumb statement like, I can't believe we're at 99% confidence intervals on volatility and it's still going higher. And then you realize they base their whole model on 7 years of data. Okay. Wow. Like this is, it's criminal. And then they get bailed out. Okay.
Right.
The Fed comes in and bails out, or Wall Street comes in directed by the Fed, bails out long-term capital management. Why? Well, because Goldman Sachs is counterparty to having bought all this protection from long-term capital management. If long-term capital management is unable to make good on their insurance that they sold to Goldman Sachs, well, guess what happens to Goldman Sachs, right? It's like saying, I have fire insurance and your house burns down, but then your insurance provider is unable to provide the actual insurance that they sold you. Right? That happens in financial markets as well. So 1998 was the first one. And again, it was based on volatility. 2008, the same thing. Okay. Contagion in markets. It started in the credit markets. The gurgling and the plumbing of the credit markets indicated that the system wasn't functioning properly. Jim Cramer got on the CNBC newscast, some famous August, I think it was July or August summer day. And he goes on his rant, which says, they know nothing. They know nothing. The Fed being they know nothing. And they didn't know anything. That's true. Cramer was right. But what the Fed did was they cut rates and equity markets rallied to all-time highs in the fall of 2007, even though the credit markets were still broken.
Right.
All right. Equity guys are absolute turkeys generally. Okay. They're absolute turkeys. If they don't understand how the credit markets work, and most of them don't. So again, play stupid games, win stupid prizes. They bought stock back in October 2007 at all-time highs when the credit market was still telling you the alarm is sounding. The alarm is sounding. And 2008, 2009 were some of the scariest times I've ever been involved in financial markets because it was melting down. There was no confidence in the system. Citibank pref shares or Citibank debt was trading at 25 cents on the dollar. Citibank. I mean, and then Lehman defaulted. You know, you saw all this happen and it happened in real time. Volatility was exploding. The Fed had to step in there and they did the right things. Okay. But again, what they didn't do after 2008, 2009, when essentially leverage from the financial system was transferred to the balance sheet of the governments, is they didn't pay down. They didn't pay down the debt that they had accumulated. They kicked the can down the road. They tried to taper. The market got upset. They pulled their foot off the tapering. They're a bunch of sheep now, right? We are hostage to any market that doesn't go up because the Fed needs it to go up. Right. And that's where we are, guys. I mean, it's sad. And I'm not sure if any of your listeners watch, but today, Rick Santelli, a guy who's been in the markets for about as long as I have, absolutely called them out today. He broke protocol with the CNBC staff. It was a great rant. He actually called out Jim Cramer and said, Jim, the only thing I've ever agreed with you on is the fact that the Fed knows nothing. You should have stuck with that. Okay. And it was beautiful. And beautiful because it's true. Again, I don't want the system to unravel, but you need to protect yourself against that. Right.
Now, do you see anything, all right, as far as like today or the last couple of years, is anything similar, or are we on a totally different?
No, it's the similarity is very simple. It is very similar. It's leverage. There's too much leverage in the system. Right now, globally, there's 4 times as much debt globally as the size of the economy. Okay. 4 times total debt to global GDP. Okay. Your global GDP is your tax base.
Right.
If a company was levered 4 times to their revenue, which is their GDP, not just 4 times to their cash flow, something called EBITDA, first of all, that credit rating would be like CCC+, like right on the cusp of defaulting because it's just not sustainable. Right. The only thing that solves this or allows it to continue is that the Fed continues to print more and more money.
Right. Which in turn debases the currency, like you touch on, and
bingo.
Yeah.
It's mathematics, Mike. It's mathematics. And this is, it's grade 11 math too. That's one of my taglines. Like it's pretty simple grade 11 math. I mean, you shouldn't be, scared of this. It's just fractions. Yeah. It's fractions. Like, it's just not something that you need a rocket scientist degree to, there's no calculus, there's no derivatives, first and second derivatives, not financial derivatives. I mean, it's pure grade 11 mathematics. And yet people just put their head in the sand. You got these modern monetary theorists that they tend to be academics who have never traded risk in their lives. And they just assume that they can write a textbook about it and be an authority.
Right. And that's, and do you think that's because the system kind of incentivizes, these 4-year cycles, right? So for president,
maybe 10-year. How about that? Sorry. 4-year presidential cycle.
No, yeah,
100%.
If somebody came in and wanted to fix this, we would have.
Are you gonna elect a guy that comes in and says we're gonna be a steer, we're gonna raise taxes, we're gonna cut benefits?
Right.
Like, who's gonna vote him into office? Right. Like, nobody, or him or her, right? Nobody.
Right. And they're gonna say the next 2 or 3 years are gonna absolutely suck.
But, exactly, man. Yeah. But it's good for the benefit of your children. And everyone's like, well, I'm a greedy bastard and I don't give a shit about my fucking children, right? Like, I'm sorry to swear, but like sometimes this just makes me so mad, right? It's just so mad. My generation, the boomer generation, may go down in history as the most selfish generation that has existed. By pulling forward benefits for us at the expense of our children. Okay. That's just really, really disgraceful behavior, in my opinion.
Yeah, it is. It's like, I want what I want and I want it now.
Oh yeah, no. It's a bunch of spoiled little brats, okay, that have never had to fight for much in their lives, right? Our grandfathers all fought in the wars that defended freedom. And now we're sitting here and we're like, okay, give me. Right. And then the Fed is there. Oh, well, we can't let these spoiled boomers down because they are who elected us into office. It's circular.
And that's why I feel so powerful about Bitcoin in general, just because, the more familiar I get with the financial system and how everything works, I almost feel like betrayed. I don't want to say betrayed, but gullible. I feel gullible. Like this whole system is kind of like engineered, and they have this the massive media machine behind it to drive GDP, like you need to go buy this, you need to go buy that.
It's a consumption world. It's a consumption world. We're based on consumption. 70% of US GDP is based on consumption. So yeah, like there is a lot a lot of incentive to get people to go out, actually incur debt sometimes to go out and consume. That's a living in the moment type of attitude, and dangerous for our kids. Irresponsible fiscal management on behalf of our politicians. But you nailed it. Look, they're not going to get another 4 years in office if their first 4 years were spent fixing the damage of the previous administrations, and then you get the political biases and everything like that. So it's not easy. This is not a great time well, firstly, you cannot fix the debt spiral. So it's mathematically impossible to fix it now. We've gone too far. So you're going to need two parallel systems. You need a system that's for fiat, which fiat currency's pretty good at eliminating the need for barter. Barter being, okay, well, I'll trade you, I'll trade you 10 pieces of plywood for your bandsaw, something like that, versus currency. Okay, this plywood's worth X dollars a sheet, and I'll give you money for that, and then I'll sell you the bandsaw on the other side. And the point being, currency is good in a short-term transaction. Think of fiat currency as your checking account. You need a parallel system that's your savings account, that's not based on fiat, because again, it's 100% certain mathematically that fiat will debase over time.
Right.
So you don't store your money in fiat. You need to store it in other assets.
Okay.
Other assets are hard assets, and the hardest asset ever created and protected by math and code, excuse me, is Bitcoin.
Absolutely. Also in the paper, you describe, and I thought this was interesting, and I wanted you to elaborate about this a little bit.
Okay.
You call Bitcoin as a default insurance on a basket of sovereign fiats.
Okay.
What exactly?
This is going to get a little granular, and I'm glad we're going here. So I've spent my life trading credit. One of the neatest innovations in the credit markets is something called a credit default swap, CDS. And in fact, those CDS markets were what predicted the downfall of Lehman Brothers far before Bear Stearns stock or Lehman Brothers equity or stock trading indicated that it was over for both of those. Okay. Now Bear Stearns was rescued because an engineered buyout, JP Morgan bought Bear Stearns. They paid $2 a share. If you go back to the Kramer rant, in the summer, Bear Stearns was at $120 something a share. It eventually got bought by JP Morgan at $2 a share, but the real value at the time was probably negative $50 a share. Okay, but it was an engineered buyout, and because Bear Stearns would benefit from the credit quality of JP Morgan, okay, maybe $2 a share is like a throwaway. Here's a throwaway amount for you, you knucklehead equity holders. But Bear Stearns, Lehman Brothers, no, it didn't happen that way. And they actually allowed Lehman Brothers to default. And the credit default swap market, though, was such that in 2006, Mike, you could buy protection on Lehman Brothers debt in the credit default swap market for 9 basis points. Now, what does that mean? It costs you, much like an insurance contract, it costs you $9,000 a year. Think of that as your insurance premium that you pay on an annual basis. It costs you $9,000 a year to insure $10 million of debt, of Lehman Brothers debt. Okay, 3 years later, in 2009, that contract is worth $6 million. Okay, so your $9,000 a year went to be worth something like $6 million. Okay, that's what a credit default swap market is. Think of it as insurance, an insurance premium that the sellers collect, thereby taking the risk that the bad event will happen, or the buyers purchase, and they pay that insurance premium to the seller of insurance. What happens in markets, unfortunately, is there's a lot of netting of all these insurance contracts. And let's say there were times when somebody out there, a big hedge fund, bought insurance on Lehman Brothers, but they bought it from Bear Stearns. Or flip side, they bought insurance on Bear Stearns from Lehman Brothers.
Right.
And you see that your insurance company is going to default. You're like, God darn it, I got to insure myself against my insurance company now. Right. So then it becomes circular, even more circular. And these spreads blow up. What is a blow up in spreads? It's increasing vol. Okay. Same thing. And that's what happened in the great financial crisis. So I always look to the credit markets for evaluation of what the true risk on something is. And right now, all your listeners probably think there's no way that the U.S. Treasury market, the U.S. Treasury will ever default on their debt, much like they thought that Lehman Brothers was too big to fail. What's a neat thing? Right now, the U.S. Treasury, it costs you about 9 basis points, the same number, to insure $10 million of U.S. Treasury debt.
Wow.
Okay, that's on the U.S. Treasury. It's not risk-free, despite what all your listeners might think. It's still, someone is paying that premium to insure the debt. And that premium is a dynamic measure that will expand as the risk increases on various things. And not to mention, look, the U.S. Treasury is probably the best credit out there still, but it's still not a zero default risk, according to the markets. But all other countries are actually more risky than the U.S. Canada, for example, which strangely has a higher credit rating than the U.S. in the eyes of S&P, it's one notch higher. The U.S. is at AA+, and Canada still has our mythical AAA credit rating, but we pay almost 40 basis points to insure our debt. Now, and when I say we, I mean anybody who wanted to buy insurance on Canada. So if you think of markets as being truth, don't look at the credit rating agency's subjective opinion. That was half of the problem. They were rating stuff rated AAA on subprime U.S. mortgage debt that wasn't even close to being AAA true credit quality. Well, Canada, I'm afraid, we may have a AAA opinion from S&P, but the market's telling us we're much closer to a very much lower rated credit. And this is dangerous because this is how the markets express their evaluation of risk. So I said, okay, look, what is Bitcoin? Very simply to me as a credit trader, we'll get into the energy stuff later, but Bitcoin is anti-fiat. And being an anti-fiat, you can calculate the value, the intrinsic value of Bitcoin, in my opinion, by taking credit default swap spreads across a basket of G20 countries and multiplying that by the total obligations outstanding for that country, and just a cumulative basket and get a total amount of value, if you will, for Bitcoin. Because Bitcoin, firstly, has no counterparty risk. When you buy Bitcoin, it's not like you've bought it from somebody. It's not like it's an insurance contract. When you own Bitcoin, you own it. It's your private keys. It's transferable, divisible. It's scarce, most importantly. It's 21 million only. It's not like this insurance thing, but what is it? As an anti-fiat, it has value reflective of what the market rates are in the fiat market. And yeah, to spoil the story very, very quickly, I see Bitcoin today as being worth about $150,000 of Bitcoin US, based on the credit default swap markets. And by the way, that number is only going to get larger as the world sees countries default, which they do on a regular basis, and the contagion. I'll say contagion because I don't want Canada to default, but our credit default swap spreads are meaningfully higher than the credit rating would indicate. And if Canada did, gosh forbid, default, do you think there'd be no contagion back to the United States? Because we are your second largest trading partner. It's just the way things work. If all of a sudden you lost your second largest trading partner, or the credit, the contracts that you had with your second largest trading partner all become null and void, that's going to impact your own economy. That's going to make your credit quality a little shakier. So that's what's called contagion. Anyway, listen, I found Bitcoin in 2016, and I maintain it's the best trade I have ever seen in 30 years of trading risk. I'm not 100% certain of the outcome, but I will tell you that based on probabilities and expected value analysis, Bitcoin is the best trade I have ever come across. That's from a trading perspective. The technology is also so beautiful where you can transfer money, value. You can transfer value to any part of the world you want, and it will settle in 10 minutes without using without using a third-party intermediary. Right. No banks, no Visa, nothing involved in the center except this beautiful blockchain. And it settles in 10 minutes. I mean, try doing that with an international wire transfer at a bank, and it's the difference. Yeah. It's really the difference between modern technology and Stone Age banking. You know.
Right. I heard that you could send like an anvil to Japan from the United States, and it would get there faster than than money would.
Oh, really? That's a cool one. That makes sense. I mean, look, yeah, you know what? I mean, look, the world has become digital. The kids that grow up these days are so adept at using the iPhone or their digital phone. It's not surprising that this will be the future. I'll just go back to my own history. I graduated in 1986, having never used a personal computer because they didn't exist. So, for me, it's like a lot different, right? This technology, man, I just found Twitter. Twitter is a beautiful resource. You learn so much on Twitter. You're exposed to stuff that's not filtered, by and large, not filtered. And look, this is just the way the world's moving. So do yourself a favor. Get a Bitcoin wallet on your phone and experience the beauty of transferring value. Whether you go to a restaurant and orange pill a waitress or a waiter and say, hey, if you can download a wallet by the end of this dinner, I'll tip you in Bitcoin. And by the way, I'll give you twice as much Bitcoin as I would have given you a fiat check or a fiat tip. And I've done that on a number of occasions. And then it's just so exciting to see people, what, you just gave me, I don't get it. You just transferred me money. And then let's say you happen to go back to that same restaurant a couple of months later, and that $20 tip you gave them turns into like $60 because, and I've done it on a number of occasions. The point is, it's the technology is a beautiful thing. The value of Bitcoin is in the network. Okay, it's the value of the network itself. The intrinsic value to me is as credit protection against central bank stupidity, which they've proven they're very good at doing one thing, which is being stupid. Okay, so you got to protect yourself against that. And then I look at it on a price of where it could go. And we could get into that if you want, but I'm telling you, the upside is very high. It's not certainty, but even if it's such a low probability as under 10% that it gets to some of the price targets I have, you still buy it at this price of 40,000 because on an expected value basis, the value is far higher than its current trading price.
Sure. I would love to hear some, because I'm thinking of Peter Schiff right now.
Oh, yeah.
His spiel is always, Bitcoin has no intrinsic value.
He's an idiot. And he's an idiot. He's conflicted. And you also have to look at the performance of his funds over the last 10 years. Mm-hmm. And they are absolutely atrocious. So first of all, Peter Schiff is a horrible risk manager, okay, because he's understood 95% of what is wrong with the current system. Mm-hmm. He is an Austrian economist. Mm-hmm. His son is great. Is Spencer. I actually sent Spencer some Bitcoin on his birthday. And I got Spencer to admit that he owned Bitcoin. And then Peter Schiff sent me a tweet. My son's only 19 years old. He's allowed to be stupid. What's your problem? And I have never had another interaction with Peter Schiff since then, but I'm not going to let the man off of that because I'm challenging him to debates on any podcast that I can get him to come on. He is a chicken, so I call him Chicken Schiff. Okay. So Peter Chicken Schiff. Right. Is a horrible risk manager because you're supposed to play probability analysis and you're not allowed to be conflicted with your own business biases. you have to look at the mathematics. So what has Peter been calling Bitcoin worthless since what? What was the price? Under $100?
Right.
Like, shut the F up. Okay,
Right.
dude, you have cost so many people so much money. And by the way, your own funds have shown pathetic performance. Why? Because the fees on those funds eat up all the profits that those funds generate. Peter Schiff is a marketing talking head that failed mathematics, or at least failed statistics. And if he didn't, then he's been so disingenuous to the investing public, he should be taken up and beaten senseless by his son. To and I say this with let's not bring violence into this, but it's really, I certainly will never forget the day that he called me out. I'm good with it. You're allowed to just at least defend your actions. Don't be a chicken Schiff. And by the same token, he's very shifty as well, because he will not accept any challenges to his viewpoints. So it's dangerous when you listen to these established old school people. Let's Charlie Munger from Warren Buffett's group. I respect those guys a lot, but do not take technological advice from what do you call a 90-year-old? It's not an octogenarian. I know it's septuagenarian is 70 years old. Octogenarian is 80 years old. I don't even know what you call a 90-year-old genarian, but just don't take the technological advice from Charlie Munger and the rat poison squared guys.
Right.
I'm not saying put all your money into it, but if you own 0 Bitcoin, you're taking a huge risk relative to if you actually own a small percentage of your portfolio, let's say up to 5% of your portfolio. And there's academic studies that have been done that show that every single investor should own between 6 and 8% of their portfolio in Bitcoin.
Right.
I'm not making this stuff up. I've traded risk for, as I said, 30 years. I own more than 6 to 8% because I actually think it's wicked cheap, and the world is in the financial world's in big trouble. Okay. Right. And you need to hedge the reality of the big trouble.
Agreed. Now, let me ask you, why do you think, okay, so everybody could look, people, more people in your business, right? Like people like you, experienced traders, had success, right? Everybody could look and acknowledge that there is a problem, but Bitcoin could be so, people could look at it and hate it, and I just can't figure out
why. I'll tell you why. Again, it's a bias. It's a people. First of all, there's a status quo bias. I'll admit, in 2016, when I had first been introduced to Bitcoin, my initial thing was, it's a Ponzi, right? Because everyone tells you it's a Ponzi, so it's got to be a Ponzi, until you actually do your own research, which most of the world is intellectually lazy. They would rather read a New York Times article on it and get all their information from a second-class, failed financial trader. So that's mostly what Financial Times financial analysts are, or New York Times financial analysts. They didn't make it on Wall Street. They failed. So they go and write for a newspaper, and I graduated from Cornell. So today I'm going to call out a professor at Cornell that wrote an absolutely horribly researched article on Bitcoin for the New York Times today. Okay. It's embarrassing to see that type of intellectual laziness. Basically the editor says, write your conclusion, or here's the conclusion I want you to come to. And it's that Bitcoin is horrible, and back it up with all these, I want you to find facts that'll back up the conclusion I'm giving you. Like, this is intellectual laziness at its worst. It's dangerous, but it happens, and then people take it at face value.
Right. Yeah, man. Now, what do you think? How does interest rates tie into this as well? And I just correct me if I'm wrong, but because I think I heard you say on another podcast that if interest rates rose to 4%, that the United States government would end up owing.
Yeah, no, it's over. Listen, and I was quoting Stanley Druckenmiller. So he's he's an extremely smart risk manager. It was his numbers. First of all, I think we're on the same page when I say this. If the U.S. Fed was not in buying $120 billion worth of government debt or debt each month, the 10-year US Treasury rate would be much closer to 2.5% or 3% than its current 1.5%. Okay. Mm-hmm. Well, very simply, let's just walk through a mathematical conundrum that the world is in. I mentioned before that the total debt in the world to the GDP is a multiple of 4, meaning it's 4 times bigger. And that includes all the debt I mentioned, government, corporate, personal. Let's put an average interest rate on that debt of 3%, which I actually think is low. But 3% in the numerator times 4 means that your denominator, your GDP, has to grow at 4 times 3%, i.e. 12% annually, just to keep pace with the growth of the debt balloon, the organic growth of the debt balloon in the numerator, just due to the coupon. Hey, that doesn't include all this fiscal stimulus, $8 trillion that the US just printed, and not to mention all the other countries. Okay, it's over, guys. Like, I just don't even, it's so simple to see that it's over, meaning that you will never escape this debt spiral. You just don't want it to turn into a death spiral like what happened with Lehman Brothers. But there is the risk that that happens. So you need to own other assets that will hedge against that risk. So interest rates going to 4%, doesn't even matter. We can't even absorb 3%, let alone 4%. So, don't overthink this. Don't do sensitivity analysis that, oh, we're good when it's 1.5%, but we're not good when it's 4%. That's all balderdash, okay? You're not good at any interest rates, including the current model, okay? Because right now that's based on a Fed funds rate that's artificially low as well. So interest rates, look, that's why I say look to the credit default swap markets. They are not manipulated. The interest rate market and complex is manipulated, but it still doesn't work even with current manipulated interest rates. So don't overthink it. Don't worry about that. It makes no difference anyway.
Okay. Thank you. And what now going back to Peter Schiff and the intrinsic value thing. Can you get, we were going to talk about some of your price predictions.
Okay, so my intrinsic value right now of Bitcoin today, if I didn't mention, I think I did on your, I think it's $150,000 just today. Yeah. And it's trading for 40. So if someone came to you and said, hey, I think this thing's worth, I think my house is worth, or this house is worth $136,000, but you can buy it for 40,000. What are you supposed to do? You're supposed to buy it, right? Well, it's no different with any other asset. So you're supposed to buy it based on that analysis. But let me walk through some of these really far out on the probability distribution or price distribution of what Bitcoin could be worth. So there in the world right now is 900 trillion US dollars of financial assets, okay? That includes all bonds, which are about 400 trillion, or all debt rather. It includes real estate, okay? It includes equities, it includes gold, fine art, store of value, currencies, etc. All of it is 900 trillion US dollars. And if Bitcoin becomes the de facto reserve asset of the world, which I think it has a very good chance of becoming, and one of the precursors for that is energy, meaning oil and natural gas, start getting priced in Bitcoin. And that I approach that in my paper. If it becomes the de facto reserve asset of the world, is it crazy to think that Bitcoin could capture 5% of global financial assets? Just 5%. And I don't think that's crazy, right? So what's 5% of $900 trillion is 45 trillion bucks. What's 45 trillion divided by the 21 million Bitcoins that are ever going to be issued? It's 2 million bucks and more a Bitcoin. Okay, do some sensitivity analysis on that. put probabilities on a binary distribution, not a continuous distribution, because that's when it gets calculus and everything gets involved, but just a binary distribution where you have X% chance that Bitcoin's worth 0, which I don't actually think it'll ever go to 0 either. But again, for the binary, and the other side is that Bitcoin could go to $2 million or higher.
Right.
And let's just do that. Say that 90% chance it's worth 0 and a 10% chance it goes to $2 million and higher. 10% times 2 million is 200,000. 90% times 0 is 0. In that sensitivity outcome, it's worth 200,000 bucks of Bitcoin.
Right. Mm-hmm.
Guys, this is again why I say that this is the most exciting asymmetric return investment that I've seen in my 30 years. And I'm not putting big probabilities on it. I'm putting like a 10% probability. What if it's substantially higher than I think?
Right.
You know, then the numbers get crazy. But let's just get through the current trading price. I often say is a rounding error. Don't overthink it. Don't be a buyer at 30,000, but not a buyer at 40,000 because you're too smart that you know that it's worth somewhere between 30 and 40. You don't know nothing. Okay. Mm-hmm. You just got to own more than 0. What
do you say? It's too smart by a half, right? That's
I have. Right? You know, you this is really good that you've, I'm flattered quite honestly that you've done that much digging on me. I appreciate it. And yeah, that's an expression in bonds. Don't be too smart by a half. Okay. Yeah.
Mm-hmm. Well, can you explain, like, for the audience, what exactly, what does that mean?
Sure. Okay. So it's a bond trading expression. And let's say you have a distressed bond, meaning the price has collapsed from 100 cents on the dollar over time to around 40. Let's say the bid offer spread is 40 bid, 42 offered. Okay. So you have a $2 bid offer spread. And, you're trying to buy some because you've done your analysis and you're like, I've never owned this company in the past, but I've done my analysis. I feel that things are going to turn around for the company. I don't want to buy the equity because the bonds are trading 40 to 42, but I'm going to put my risk capital into the bonds. And you think eventually these bonds have a chance of being worth close to 100 cents on the dollar. But let's just say, you know, that they're a good probability they're worth 80 cents on the dollar at least. Okay. So you go into the market and you say, hey, to the seller, I know the market's 40 bid, 42 offer. Rather than just paying the 42 cents and getting your bonds in, you get too smart by a half and you go in and bid the seller 41 and a half. And he doesn't hit you or sell into your bid. And the market dies 41 and a half, 42. And then it gets posted around the street. Hey, we had these bonds 41 and a half, 42, no trade. And some other guy goes, you had bonds offered at 42. God darn it, I'll buy those. So then all of a sudden it goes 42 bid and there's a buyer in front of you. You know what I mean? And then you don't get the bonds at 42 and then they trade at 46 and you get pissed off and the trade, you miss the trade altogether. And someday they are worth 80 cents, but you missed the whole trade because you got fancy by a half. That's right. And you went in and tried to buy these bonds at 41 and a half when you could have just bought them at 42. Pure execution. And listen, that happens all the time. People are always too smart by a half.
Yeah. All right, last question before we wrap it up. Elon Musk recently talking about, you know, the energy FUD.
Yeah.
Recently talked about possibly once the network or once the miners can prove that they go 51% renewable, he'll go back. I think it's irrelevant because, in my opinion, Bitcoin is a store of value. You know, I'm trying to store my value through time and space. I don't really care too much to spend my Bitcoin, right? Especially on a Tesla. What are you thinking about that?
I love, so you've done a lot of really cool research. Look, so Elon Musk is a rocket scientist. Okay. If you're going to listen to a rocket scientist, listen to Michael Saylor. Don't waste your time with Elon Musk. I just want to draw a parallel. Do you think Elon Musk's electronic vehicles or electric vehicles are charged entirely with green energy? Or do you think some of them might be actually being charged with coal and, you know, come on, stop, full stop. Do you think wind energy is actually green? Let's talk about that for a second. Do you know that the amount of energy that goes into constructing the steel or fabricating the steel that a wind turbine is constructed with, it's very seldom unless that wind turbine is placed in a very favorable wind alley where the wind blows all the time at 18 knots per hour, that turbine will ever make back the amount of energy that was required to put the steel into that turbine to begin with. Not to mention that those blades are fiberglass, and it takes thousands of years for those blades to decompose in a landfill. And they do all sorts of other things like kill birds and create low frequency humming that drives people crazy that live near these wind farms. So look, you got to be really careful what you call green energy to begin with. Then you got to do your law of conservation of energy, excuse me, and realize that proof of work is what keeps the Bitcoin network secure. So you say, how much energy does the Bitcoin network actually use? And your fudsters will say, oh my God, it uses more energy than small countries. And I'll say that's true, but it's also more valuable than small countries. And secondly, of all the energy it uses, it's still only 1/10 of 1% of total energy consumption. Okay, that's the Bitcoin network. 10 basis points, 1/10 of 1%. I suggest you focus on the other 99.9% of energy that's being consumed and look at where the waste is occurring in those and whether it's polluting the environment. Okay, Elon can say all the stuff out of one side of his mouth, is at least until he actually applies the same logic to his charging of his own electronic vehicles. Okay, the electrons in the electric grid are not smart enough to say, I was produced by a green, whoever designated a hydroelectric dam green. I'll take issue with that. My business partner at Validus Power is 100% Canadian Indigenous. They don't think that these power dams are that green when it floods up their tribal lands in Northern Ontario. That's could be green for some people, but it's not green for these people. The amount of concrete that goes into a hydroelectric dam, concrete is much like steel. It's one of the most polluting, most energy intensive production processes. Oh, but once that dam is completed, again, it's this FUD, this hypocrisy. But let's just say that we designate something as being green. And on that note, I will designate nuclear energy as being one of the most efficient uses and sources of electricity production there is out there. But how many people consider nuclear energy to be green? Not that many. Nonetheless, you have a grid that's a mix of all these different production electricity generators, whether it's natural gas, whether it's coal, whether it's hydroelectric, wind, solar. The grid does not differentiate between electrons that were produced in the green side and they go right to your Tesla vehicle. Guys, please stop this garbage. God darn it. And Elon knows this. Right. Yet he'll never tweet that because why? Because he's trying to play this ESG game, this environmental and social governance game that itself is an inefficient regulation. And Elon's a rocket scientist who's actually lying to people. Right. And he knows it. And as a Canadian, I'm calling him out because he is half Canadian and I'm allowed to call him out. Okay? What he's doing is absolute hypocrisy. He understands it. He's playing us as fools. He's allowed to. But don't ever take face value. You need to do your own homework. So listen, if the grid ever gets to be 50% green, that means that his electronic vehicles can be charged with the same electricity that can be used on the grid to mine Bitcoin. But what's actually going to happen in the future is most Bitcoin mining is going to happen what's called behind the fence or off the grid. And so the power company that I'm involved in right now, we have sources of energy that are not on the electric grid. These could be things like natural gas, flared natural gas energy in oil fields where we wheel up a turbine and within 6.5 hours, we're taking that energy that's otherwise being burned into the atmosphere. We're running it through a jet engine and we're creating megawatts of energy that can be used to mine Bitcoin. And by the way, we're cleaning the environment. Okay. Is that clean energy? Yeah, 100% that is. Okay. And why is it green energy? Well, because we are taking an otherwise flared source of energy that's polluting with acid rain. If it's not being burned, it's methane. Methane destroys the ozone. Listen, there's just so many different ways that Bitcoin mining actually helps the grid and helps the environment. And you just need to do a little bit of math, a little bit of physics, a little bit of research, and not listen to these fudsters out there that are promoting lies.
What's the name of your other company? You said you're involved in a mining company. What's the name?
Well, it's not mining; it's an energy company. But some of our off takers are Bitcoin miners. Okay, it's called validuspower.com. VALIDUS power.com, and you can go onto that webpage and you can see these beautiful engineering machines that look like, well, they are trailer trucks, but they're like not 18-wheel trailer trucks. They're like 50 wheel trucks that wheel in these beautiful engineered jet turbine generators and create megawatts of power, enough sometimes to power a small data center. And some of the data center could be used by an Amazon Web Services, and part of it could be used by a Bitcoin mining company. And that's the beauty of it.
All right, hang on. I'm gonna get off and just stay right there. Okay.
Okay.
All right, guys. Thank you so much for watching. Greg, thank you so much for doing this. I had a great time chatting with you. Guys, make sure you follow Greg on Twitter. His handle is at Foss, Greg Foss. Like
Thank
Bond,
you.
Like Bond, James Bond.
So here's the funny thing. So when I finally, and that's what I thought of, I said, Twitter was suggesting a handle for me. And Greg Foss was taken, and Greg Foss 17 or all these other ones. I said, okay, I'm not going to do that. But they suggested this one, Foss, Greg Foss, that wasn't taken. And I said, I'm never going to use this handle anyway. So I'm just going to take it because I only want to be on Twitter to say I had one. And now I have a bunch of followers. And I didn't do it because I'm what would call it, like a narcissist or whatever. Like I want to be like James Bond, but hey, people catches it. And the funny thing is, hey, I'm 57 years old, so I'm allowed to claim that I was hoodwinked into that, into that Twitter handle, you know?
Yeah. It was generated.
Yeah, that's right. So yeah, that's my handle. And I'm open to arguing. I'm just trying to help the world understand that I believe this to be a very beneficial technology. The beautiful thing about a platform like Twitter is you don't have to always get your information from mainstream media. You can actually get conflicting voices. I am a conflicting voice to people like Peter Schiff. I'm a conflicting voice to people like this Cornell professor, Anwar or Aswar or something like that. He just published something in the New York Times today. As a Cornellian, I can call him out, and I can call Elon Musk out too as a Canadian. This is garbage stuff that these guys are producing. They probably know it. If they don't, they've been intellectually lazy and haven't done their own homework. And why am I doing this? Because I have 3 kids and I care greatly about the future for our children. This is the future, ladies and gentlemen. It's that simple. And if you have been fudded into the corner that you're not going to buy Bitcoin, you only have yourself to blame. You've been intellectually lazy, and there's not much more I can do to help you. I'm not doing this because I'm trying to dump my Bitcoin on you guys. I'm going to own Bitcoin so I can transfer it to my children. I'm not doing it so that I can trade it back into piece of shit fiat currency, US dollar shitcoin. Okay. I'm doing it because I want to own Bitcoin as a store of value, the purest monetary energy ever created by mankind.
That's right. And you're doing a great job of it. And, at least for me, I'm grateful that there's people like you out there. It really helped me speed the learning curve. I studied this hard for about 12 months. I don't know how long it would actually took. And I feel like I'm just starting to really get
I've done it since 2016, and I promise you, I still learn every day from guys like Marty Bent. I learn about Taproot. I learn about Layer 2. Listen to Jack Mahler's talk about at the Bitcoin conference, which incidentally I spoke at, and I've never been surrounded by so many energized people in my life. I was so flattered to be part of that. Jack Mahler's is unbelievable for a kid that's less than half my age. And I swear to you, if he ran for president, I would vote. And not that I get to vote for president. God, I'd love him to come and run for prime minister of Canada. The guy is brilliant. He's beautiful in terms of his commitment to want to help the world. And I'm just trying to do a little bit about, you know, I've seen a lot of stuff that a lot of people haven't seen. And I'm able to call out these guys that are like, oh, it doesn't work this way. No, it does work this way. You're just a coward. Peter Schiff, you are a coward.
That's right. You got it over here. Chicken Schiff, right?
Chicken Schiff. Chicken Schiff.
All right, guys. Well, thank you so much for watching. Make sure you guys tap that like button, subscribe. Again, thank you, Greg, for doing this.
My pleasure.
Do it again one day.
Mike, absolutely. Thank you for everything you're doing, because it's important for the world to hear it from different angles, and you're doing a great job.
Thank you very much, Greg. I appreciate that. See you guys next time.